Let me see.
I'll pass for right
All
right
right.
now.
All right. Good evening, guys. Ken Tortoise Capital Foundation's Q&A for July 6th, 2023. This is a free one. No questions directly submitted, so I can give you about 30 minutes tonight. Then I have to play some catch up on the reports, and I got to work that spreadsheet, and I got to do some work for a faculty development program. I've been teaching for the Army for 23 years, but I have to demonstrate proficiency at the elementary level of teaching the experiential learning model, or they won't extend my contract. It's it's kind of surreal. So, so go ahead, Lou. You're first in the barrel. If you have any specific questions, I know you just started the course. It looks like you're able to navigate okay, and you're able to upload some case studies and campfires. So my spider senses you're probably okay.
I think so. And yeah, I was just telling the others, just getting through the material, just a lot of really good material, Ken. So I'm sure I'll
Yeah,
have questions. Just want to go through it probably a couple times
yeah,
before I do. But happy to be here.
yeah. I would say the best way to go after that stuff. That we're all there's a it's almost like the sin of gluttony. There's almost too much material in there. That there's a lot of the recorded lessons in a structured way, but then I think the twice weekly Q&A sessions are some of the best work we've ever done, and so it's kind of hard to say, hey, well, wait until you go through the entire course, then start listening to those. I wouldn't recommend that. I'd probably try to do like a lesson a week, and then listen to the two recordings, uh, the next two recordings in the Q&A session, and that'll give you kind of like a focus lesson, but then also sort of the sticky points, which I think get better explanations in the Q&A. And then I also just think that the sooner that you get into listening to the nightly podcast and sort of watch these things come together and see the coaching, the better off you'll be. I have said before that I think that's where the real workshop is um, in the nightly work, and that's because that is sort of that's a live operational trading focus. Current market, current decisions, work in progress. Whereas sometimes lessons can be a little abstract. But I just start monkeying around with it, get your arms around it, and the
Yeah,
sooner,
thanks.
yeah, the sooner you start posting charts like you did, the better it is to start trying to carve wooden bowls right away. Is how I would recommend.
Got it. Thank
But
you.
one of the things I'm sorry to barge in. One of the things I was going to say to Lou is, from my own experience, since I've started to attend the nightly podcast about 8 weeks ago, it's been a very good learning experience. It's hands-on, uh, and it's helped me make a lot more progress than just looking at the lesson. That's from my perspective.
That was actually the topic we had in our little faculty development program today, and that was the how do students learn best? Active learning, in which students are doing things that have outcomes and that you can get feedback on, which cause the lessons to be living. Active learning is by far to be preferred over traditional lectures. And then problem based learning, in which you're not just doing activities, but they're organized around a specific project or a process that you're. So you have a sequence of activities that take you from simple to complex, from start to finish. That kind of stuff is also um, a. It's well supported by research that that's a better way to learn at the mastery level of of learning. So the more trades you post, the faster you're gonna end up learning. Has been our experience.
Thank you.
Yeah. So, either any other guys got any specific questions?
No, I just wanted to thank you, Ken, for replying to my email.
Yeah.
I thought you were going to cover it tonight during
Yeah.
the session at
Yeah. I
Q&A,
mean,
but
it looked to me as I think you're thinking about starting the 30-minute swing.
yeah, that's what I'm aiming
Yeah.
for. Yes,
Yeah. Yeah.
yes,
Yeah. So yeah, if you do that, then the risk the stats that you showed there are all from the auto framer,
yes.
and that's appropriate for swing trading one day at a time. You would typically see the stop on that is probably 8 to 10 times wider than the 3 minute. You know, the R10 is 1/10 of a range stat, whereas the typical auto framer risk is going to be the size of yesterday's candle, and if that was an average range, that's going to be about 8-ish of the little mini R10 boxes. So yeah, that's as long as you keep those separate and distinct in your mind, you'll be in good shape. I was interested, Lou, seeing the 15-minute bar looked pretty good on that chart you posted. That has it has some of the qualities of the 30, and that it is slow and orderly, gives you time to decide. So,
Yeah, at least for me yesterday. And I'm not home all the time during the day. This week just happens to be I'm off this week, but
yeah.
yeah, it seemed to make it a little bit clearer, at least for me. But got a lot to learn.
Yep. Well, it gives you time. You know, it gives you time to respond to surges, the anomalies, the little blips that on a 3 minute chart or a 1 minute chart might cause a run of 2 or 3 bars and then nothing. That's just kind of noise inside a 15-minute candle. So there is less surprise in a 15 or a 30. I
So
think those are kind of ideal. Yeah, Greg.
as we jump down into lower time frames, let's say specifically if you're trading even on the forex market, spread
Yeah,
becomes a larger issue, just because anytime
yeah,
that you're out and back in, it's almost sometimes half the move on these lower time frames. Do you have
yeah.
any feedback or thoughts on that on spread?
Well, I actually on forex, I trade the forex futures pairs, and I've been using like 15-minute and 30-minute bars on those, um, and the spread doesn't seem to be as big an issue there because you get wider stops and it takes longer for it to kick you out of a trade. So the frequency is not as bad. The other thing I've tried on that is a few years ago I was monkeying around with tick charts. You know, anywhere from 800 ticks to 2400 ticks, sometimes as little as 200, which gives you a very orderly looking chart. You know, because as you get a trend, there's no tails on it. It's just filling up with boxes. And then when it works, you just gotta you get 1, 2, 3, 4 boxes in a row. So it's not time, it's transactions and true price. So I enjoy the tick charts a lot. A reversal of 2 seemed to be like a nice. I'm trying to remember the name of that uh, the chart pattern that works with where where it takes it has to reverse 2 boxes to get a true reversal. Um, so yeah, I mean I can't trade the I know Luke does like the 5 minute on the Aussie. I've always found that to be a little too quick for me, and I typically go with the 15 minute and then negotiate from there. But I'm much more on the index futures than I am on the currency futures. And just I like the indexes better.
Did you ever do any kind of craziness where you just did a system for like the 1, 2, 3 exit? and like entry and exit and just
Yeah.
do like quick hops or anything like that?
Yeah, that actually is, the 1, 2, 3 exit and entry is really the first in the whole sequence. Unless you have a bottoming tail where all that price action is happening immediately inside one bar, the normal play on that is a 1, 2, 3 is about the first time that I feel like I've seen enough information to get in. And what's important on that one is to I would put the Z2 lines on that, so that when the reversal happens, you want it outside of a Z2. In the space between Z2 and Z3, because that says that you just had a significant directional move, and then this is the first opportunity for a reversal, and it's happening at a distance that if you just get a return to the mean, you're going to get, there's a 2-to-1 trade there. If your stop is approximately 1 Z-score, I enter at Z-2 and my stop is at Z-3, then it's a 2R move by definition to the middle of the river. And if it gets to the far side Z2, that's a 4-to-1. So the only problem I've ever had with that is if I got caught up in trying to trade too much and taking every 1, 2, 3 entry, but it was not in a critical state. Like it hadn't just made a big move that this is the reversal of. So that would be my caution. And then just simply putting the Z2 lines on there will ensure that you're starting from an extreme condition. And then if it fails, then it looks like a continuation of the previous extreme condition. So you want it to be in play whenever possible. And that's just general guidance on any time frame. I want to see things that either just completed one giant move or are so abnormally sideways quiet channel that it's a Z3P or a super pinch, and the absence of directionality and the absence of volatility is what makes it special. The coiled spring or the acorn. So that's what I would say on that. And then finally, if I was going to do anything with the 1, 2, 3, I would always have the standard risk box on there too, and anchor that to the bottom of the maximum excursion. And then as you're watching and waiting for that 1, 2, 3 to develop, it's filling up that box as it moves higher. And at some point, you'll either go because it's more than one risk box off the bottom, or the 1, 2, 3 was completed. If you have both of those on there, then you could actually get in before a 1, 2, 3 on a sharp reversal. Instead of waiting for a full 1, 2, 3 and then the move is over, it just moved. It's already moving so hard, so fast that the distance traveled is already, that's where your safety is. So if you're going to use the 1, 2, 3, I would always have that risk box on there anyway. That visual box trading lessons that are in the foundations are really, I think, refreshing. It shows you how little information you need to have on the chart other than price to make good decisions. I mean, I like to have the indicators on for the entry, but then later just kind of shift to a chart that has just the visual box on it, and that has a very calming effect.
Yeah, I think it's totally slick. Dividing sort of the chart or the market into frog boxes and MMRBs and just doing everything. Awesome.
Yeah. So you have that one where you're doing all your hard work, your framing and your layouts. It's almost like a blueprint. But then when it comes time to actually watch the corn grow, I don't want to give myself extra reasons to fret. So the visual box trading actually performs that function for me. It's just simple support and resistance in a standard range, and that lends itself to the R10 treatment very nicely, you know, because you got 10 of those little boxes in a normal day.
I'll keep going if no one else has questions.
Go ahead.
I noticed in some of the other trades that the guys were posting, some of them increased their stop to, for example, instead of 1R, they would do like 1.5R when they expanded it for a larger or a longer term trade.
Yeah.
Is there any type of rule set for expanding your 1R?
Yeah. Well, the way I look at that is this: that whatever time frame I'm making the decisions on, where I have framed the trade, there is some logical relationship between reward and risk that I made, right? So if it was a PSAR flip on a 15-minute chart, the bottom of that PSAR flip is the price that tells me the trade didn't work. So yeah, I can just arbitrarily make that 1R. Now, you've also heard me recommend arbitrarily make that 0.6R for position sizing. And that way, you're not trying to front run your own exit in that yellow zone just so that you don't take more than a 1R loss. So that really will calm you down quite a bit. As far as expanding the risk box to 1.5, I don't do that, and it doesn't make sense to me in the logic of how I've been teaching to think about that risk box. Like, there is a price mathematically that tells you that on that time frame, that trade isn't working. That's your execution risk. So if you just call that 1.0, that's enough, you know. The only time I would, vary from that is if the standard risk box was $1, but because of reasons, the PSAR flip was only 50 cents. Now, we saw that yesterday in one of the trade cases because it was an afternoon trade and it was very quiet volatility, and the PSAR flip was so small that when I took the entry on the break of the PSAR, the price that would get me out would be a reversal of that, another PSAR flip. But that was only going to be half of the standard risk box. In that case, I don't make the risk box the size of the PSAR. I stay with the mathematical R10. That's already really small. But what that lets you do is it lets you position size against the wider mathematical stop. And if you get an adverse price that invalidates the hypothesis for the trade, you're going to take a 0.5 loss, which is already a 0.5 improvement. But going the other direction to have a wider stop, I guess I would say the place where you would see me do that is if I was trading a 3-minute bar and I was using the R10 and we got 4 or 5R into it and I decide that I want to convert that to a swing trade using a 30-minute chart. It's typical when you go from 3-minute to 30-minute that the width of the PSAR flip box is 3 times larger on 30 minutes than it was on 3 minutes. So if you're going to follow the logic that if I'm trading on 30 minutes, the 1R loss is the size of a PSAR flip, well then the size of the 1R box is 3 times larger than it was on the 3-minute. And my position size is therefore going to be 1/3 as large. But I'm still operating in units of 1.0. I don't like when a trade is successful that I give it more room and I put my stop. Now, I will put a stop where it seems to be logically necessary. Like I make a decision, I'm going to put the stop at the PSAR. Oh, it turns out that is a maybe that's a 1.5 or a 2R reversal from the maximum favorable excursion. My decision to put the stop where the stop is was as a result of where the PSAR was, or the dragon, or wherever whatever technical indicator seemed like the correct place to put it. And then I might notice, oh, I'm giving back 2 full R. Maybe I don't want to do that. And then I might just tighten it up even further, because upon further review, we go to the VAR. On further review, we only want to take a 1R cushion there. So I don't sort of just like arbitrarily say, well, I'm going to increase my stop from 1 to 1.5 now, unless it was in the act of moving the stop up. I moved it to a logical place, and it just happened to be 1.5. That's not why I put it there, because it's 1.5. I put it there because that's where the PSAR dot was, or where the edge of the dragon was. So I'm looking for the indicator to show me the statistically significant location of the stop. After I put it in there and get my risk out, and I'm satisfied that I did that, I then usually have a little bit of time to say, oh, I just noticed that thing is 2 MMRBs away. I don't want to give back that much, and so I might tighten it up in that way. So it's always, any subsequent adjustment is always in the direction of lower risk or less risk, preserve more of a gain than it is to widen it. Like, oh, I moved it up to here, but now it's getting dangerously close, and I really want to stay in the trade, so I'm going to widen it now arbitrarily. Never do that. Once you've put that marker down, have the discipline to leave it there. And I've never regretted that, because I know how to re-enter, so that's no big deal. I hope I'm always getting out too early, so that I have an opportunity to re-enter. Right. So did I answer that one? All right.
Yeah, it's good. I got another one if you want.
Okay.
I'll keep going if no one else
Yeah.
pops in.
Sure.
In honor of yesterday and today of the market, there was a lot of compression and a lot of chop, if you
Yeah.
will. So other than the Z3 channeling compressing in,
Yeah.
are there any other filters that you might use to help yourself avoid the chop?
I usually don't, and the reason is 2 days of a sideways quiet channel is usually about all it can take. The intraday traders are saying, hey, let's go, we need to do something here. And it may be that the right way to answer that is to say, take a look at what is on your radar screen for all the symbols that you're tracking. So if you take a look at my standard tradables in there, the one that's on the daily report, there's probably 50 symbols in there. And there's a mix of conservative indexes, aggressive indexes, regional indexes, country indexes, individual stocks, large, medium, and small, some that are very narrowly focused on the energy sector or steel, or something that's very broadly exposed, like a General Electric or a Home Depot or something like that, or a Tesla. So I believe that your ability to find a mover is connected to what's in your herd, what's in that subset of the market that you've chosen, such that 10% of them are always moving. Something is moving, and so I spend time looking at the sector spiders for the S&P, for example. I look at 4 of them, materials, energy, finance, and tech, with the idea that tech is often very trendy, aligned with the broader market, but materials, energy, and finance tend to be very cyclic. Like one or more of them will be the thing that is leading the way and is the strongest in the sector, or the strongest sector for the market that day. So that thing's moving, and then all the companies that are connected to that index are probably moving large, while the other ones are just middling or through. So my sense is that instead of trying to make a trade inside an index that's not moving, you're better off scanning across your subset, your herd. I think of them as I'm just managing 50 or 60 cows in that herd, and some are running, some are chilling, and so my shift is to find the mover rather than filter out the quietude. So as long as you are respecting the harsh winter as the precondition for an SSC to initiate the whole sequence, you're already starting with something that is in play. It made the move that announces that that thing is in play. It's almost never the case that on these large caps and these sectors and ETFs that, there was one and exactly one move, and now it's at the new perfect price. There's always follow-ons or reversals. So giving them the first move to establish that it's in play is a way to find the filter. So if I was going to convert that to a filter, then what I would be looking at is the MACD 4 seasons. And where is the signal line with respect to the Red River? So I want something in the winter that's out of the Red River. Perfect. It's failing large. I can tell you that's already a collapsing dragon. So that's either going to just keep going, or when it reverses into the spring, now I'm in the wheelhouse to start an SSC series. So I would take a look at that one. If you have any proficiency on the charting package, you can do a Z-score on where the MACD signal line is with respect to the Red River. Because the Red River, by definition, is plus or minus 1. The northern skin of the Red River is Z plus 1. The center point of the Red River mathematically is the Z-score is 0, and the southern skin is minus 1. So if I have just like two columns on my sheet, I can say, we're in the winter, sort by season, and then find anything that's worse than minus 1. Done. Well, and then on the other side, a summer is always a good thing to look at too. That way, you're finding the things where the momentum is likely to continue. The final thing on that would be is just watch where watch the shape of the Bollinger Bands. If you've got the Z3 lines on there, if they're expanding, there's still room for it to work. If they're already starting to converge, then stay out of it. The next 2 or 3 trades are likely to be choppy until it gets to a super pinch. But I would much rather try to find the mover from my larger herd than try to fine-tune inside a market that's getting quiet. There's just no wiggle room inside there. Yeah. Next.
Keep going. No one else? Anybody else?
Yeah, Chinlog, we're just there were no questions submitted, so we're just doing free-form Q&A.
On the looking at measured moves, I've stumbled across things. You mentioned like almost cycles or cyclic kind of, or like a heartbeat for the market, and then it would move. Do you have any thoughts on things like the GAN or the Elliott wave or any of that kind of stuff? No.
Now what's interesting is that when Jeff Boccaccio interviewed John Bollinger for the Society of Technical Analysis, Jeff had sent him a bunch of my stuff to look at, and he asked him what he thought about the way we trade it. And Bollinger said, "Yeah, that very sound." And I think he either said it was either he said, "Look, there were elements of Elliott wave in there," or it was some other market cycle. I can't. It wasn't Mark Chaikin. I try not to follow other guys' work too much like that, because I feel like it dilutes what I'm trying to do, or I'm trying to adopt their lens, and it distorts what I'm trying to do, and there's tension there. So I know that Elliott wave is a thing, and I know Fibonacci's are a thing, but I just sort of use my own brute force and ignorance approach to to me, Fibonacci, a half and a third, and 2/3. Enough. That's enough. Top and bottom 10% have it. Just not trying to over-engineer that. But yeah, Elliot. I almost had the name of the market cycle. Wyckoff. Yeah, Wyckoff theory. I think he said it reminded. Our work reminded him of Wyckoff theory, which he thought was a good thing. That's a out of body experience, by the way. When somebody's interviewing John Bollinger and he says, "Oh yeah, I know this guy's work. It's pretty good, and here's what it is." That'll make you sit up and take notice of yourself. The other time that happened to me in a serious way. Actually, there were two of them. One of them was Howard Bandy had just written a book on reversion to the mean trading, and that guy is just flat out genius. It's just amazing mind. And I had sent him a note and just said, "Hey, I just wanted to congratulate you on that wonderful book, and to let you know that I use you as an example to my son about what the life of the mind can look like, with mathematics and stuff." And I said, "Here's how we do reversion to the mean trading." And I told him about Bollinger Bands and the RLCO and all that stuff. And his reply to me was, "Wow, I didn't think of that before. That's really cool." That was an out-of-body experience. So sometimes, when your heroes say hi at a concert, you remember that forever.
You're my hero. Anybody else? I'll keep going, guys.
Keep going.
Keep going.
Every second I can get from this guy, I'll keep going. The any kind of tracking or unique tracking that you do, because sometimes that will use the difference between execution R, and then we'll extend it for position R, and then looking at my reports, I'm thinking, well, it says I made 1R, but I didn't really make 1R because I took the position at 1R. So correcting that discrepancy with the counts.
I try to just round it off as best I can. Like, to me, like a 0.6 loss. If I really like that idea of, if your execution risk, just set that equal to 0.6. Seems to be good enough, because then you still have a really good fighting chance of seeing 2 or 3R available on your normal move. The execution R is connected to how much money you actually make, but the measuring it against position sizing risk is the proper way to do it for evaluating the quality of the system, right? Because what we're really searching for is an extremely tight doji at the turning point. typically, because that's going to give us the smallest yellow zone, the smallest risk box that we can. And if that's smaller than the 1R position sizing box, you don't want to set the execution risk to 1, because then that drives you will want to have the largest feasible position size. And then but that's also going to be the one that fails the most often. So what you'd like to do is just accept it as a little gift. This is one I need to draw a picture on, so you can see that there's a psychological lesson in here, I think, that's worth looking at if I can find my pen. Oh, there it is. Let's see, share screen. Yeah, so the idea looks something like this. Let me get my drawing pad connected here. So in the first case, we might have had something that moved down, and the typical PSAR flip box might have looked something like this. So we ended up getting a box of that size. Whereas on the next one, and it terminates in some tiny little doji, and I might actually even be able to do this, whereas my normal minimum manageable risk box might be like that. All right. So here's a case where what matters for this one particular trade is that any price below that red line invalidates the hypothesis. All right. That's the reason to get out of the trade. It's no longer working. In case B, this thing is probably like 1/3. I tried to draw it to about 1/3 of the size of the normal risk box. All right. So the guys that are coming in to buy this, with however much money they have, it's the same amount of money, and they're going to move it the same distance up until the buyers are all done and there's nobody left. So from the moment of entry, there's only going to be $3 of gain, right? And on this one, if my risk box was 1.0, and if on this one it was 33 cents or a 0.3, this thing is going to move 3 against a standard risk box of 1, so I'm going to get a 3R. And on this one, I'm going to get a 3R. But on case A, if it fails, I take a 1R loss. On this one, if it fails, I get out here, I take a 0.3 loss. So the difference is between, they both had an upper limit of 3. One had a -1, the other one had a range of -0.3 to 3. That's not that significant of a difference. If they win, the size of where I had the risk box didn't even matter, because it never came into play. And the position size that I had on both of them was identical, so the number of shares that I had, which equals very specific number of dollars, that's the one that is, I can spend that. But for analysis purposes, I'm looking at the R capture independent of the dollars at risk. Because if this is in early days and I'm just doing this at a prototype, maybe I'm only risking $100 a trade. And if it's a low production, I might be at $200, and if it's at full production, I might be at $400. The R capture is always the same because it's dealing with the geometry and the architecture of the trade. Where it's different is in the actual net dollar differences. So if I fixate on this, I lose fidelity on the quality of the signal. Because the quality of this signal and this signal, the quality of the trade frames is independent of the amount of money that I put on it. The quality of the signal was the R capture compared to the R risk. So I want to isolate the R capture and not get confused by the amount of money that I had, so that over a series of many trades, I have enough data to say something intelligent about those two different trade frames. So the only real difference between A and B then is that if this one fails, there's a 0.7 improvement, whereas if this one fails, it was the full 1 hour loss. But they're both identical on the winning side for comparison purposes. It's just that on one of them, I was fortunate that it was unvolatile enough that I was actually able to get an even tighter stop. That doesn't lead me to try to increase my position size. I just look at this as a way to minimize the downside risk if the trade doesn't work. If that's where my advantage is, I don't want to be larger on that, because if the trade fails, then I take a larger dollar loss. So that's not good. You know, and the main point is, if I'm using the R10 as my MMRB, that thing is already so tightly compressed that most people would legitimately look at this as being a noise box. So if I'm trying to, I see an opportunity to make my risk box this, I'm already inside the noise. That's not a reason to make my position size 3 times larger. I shouldn't be messing with that at all. I should be using the R10 or some multiple of that for my standard position size, regardless of how close I was able to finesse my initial stop. And then the R capture on the win is always going to be about the quality of the signal at that turning point, independent of where I had my initial stop. So one way to look at this is say, look, hey, what if I made my position sizing risk box very wide so that my MMRB was only a 0.2? Well, that just means that those R captures that I'm making are going to be fractions of 1. But that's okay, because it's the ratio between the capture on the winning trades versus the loss on the losing trades, and the consistency that's going to give you a system quality number. You know, if I have a bunch of trades that win 3 and lose 1, but because of position sizing, I have a bunch of the same trades, I'm winning 0.3 and losing 0.1, same number of trades, that's going to give you the same system quality number, because the standard deviation will be so small here that it offsets the smaller size of the gains and losses. So you'll get the math is the same. It's the ratio between the wins and losses that ends up driving the system quality number. So, long story short then, I guess, to me, I just look at the PSAR flip as the sort of the standard. That's one execution risk, and if I just arbitrarily make that 0.6, I have a nice comfort zone. Now I'm not tempted to try to front run and exit inside the noise. I can just wait for it to break and take my little 0.6, and then I just have to have 3 0.6s to the upside, which is really just a 2R. compared to the size of the standard position sizing box, right? So that's what I want to say on that. Keep a clear separation in your mind between the R capture analysis, which gets to the quality of the signal, and then the common sense, practical nature of the number of shares, the dollars at risk, and the true plus or minus of real dollars in the portfolio. That matters a lot when you're managing exits. But in order to decide what system is working for you, you need to isolate just for the R capture. Okay?
I have a question, and maybe it's tied to the one that Greg asked. Is there anywhere in your material anything about taking consideration
About
like
the what?
commission fees?
About commissions?
Yes.
Oh,
I mean, do you
irrelevant.
think that
Irrelevant.
do you think irrelevant for
Irrelevant.
your arc?
Yeah.
Irrelevant. Okay.
Yeah. Because there is some cost of doing business. The larger as you start scaling up, so there's probably something like a flat fee for the trading cost per trade. In the early days, if you're trading one share, that's a large number compared to the wins and losses on one share. As you start scaling up from one share to $10 of risk, or to $25 of risk per trade, to 100 to 200 to 400, wherever you draw the line and say, this is where I'm in production, this is where I have I'm trying to exploit my resource with my maximum standard risk per trade. Up until that point, you're just kind of pilot testing and prototype, maybe starting to scale up in here. As you start going up this one, the importance of the cost of commissions becomes trivial. Should you always strive for lowest cost of ownership and carrying cost? Yes, but you also have to take into account, the quality of fills. If you save $1 on a commission, but you lose $100 because they give you shitty fills, that's not helping the team. So you have to take a look at, the cost of commission plus the typical slippage. And typically the brokers that have the best, tightest spreads and the smallest slippage may end up costing you a fraction more on the commission in a perfect world. And because of competition, the cost of doing business is going to zero. It has to, because that's where they can compete, and where they're going to get paid is by having your money under management and earning the intraday interest, and then getting the commission for leverage and your margin rates, and then just the amount of time that they can hold on to that while it's clearing. They're earning the interest on that. So to me, what you're looking at is how quickly can I scale, based on evidence, how quickly can I scale my size towards a production level system, and then that is going to cause the money that I'm paying in fees and slippage to become less and less important.
Got it.
I know nightly talk about positions, and often you're quoted as saying, I just used $400 for my average position size.
Yep.
If you were to suddenly relax from that particular rule and you were going to use, let's say, 1% of your account, how often do you rebalance? How often do you say, I'm going to recalculate my
I've
hours?
stayed at $400 of risk per trade for 12 years. I am just comfortable where I am right now on that. As the more and more successful I'm getting, and as the portfolio grows, $400 risk per trade was some X percentage of portfolio, and out here it's a even smaller, because you got to buy the position. So I don't even care about that. And the main thing that I would say is that when you're trading in a production style like this, like a manufacturing process, and you have a standard frame, and maybe I have 1,000 trades with that particular architecture of, hey, 3-minute chart, and it came down to here and it went up here, and I drew my risk box here and I set that equal to 0.6, and I position sized off of 1.0, and then you end up getting 1,000 trades, or 300 trades, or whatever. I really like that. Now I want to get larger. So now what I don't change the architecture and the geometry of the trade frame, where you have 1,000 pieces of evidence that you can trade that way. All you got to do is change the number of dollars at risk per trade. So instead of trying to reduce the risk box so that I could get my position size larger, leave the architecture exactly the same and just go from $400 to $500. I like to think about a 20% increase. See if I can handle that without losing my mind. And
So you're doing it on the count of successful trades versus time.
I'm sorry, say that again.
You're using whatever the number of trades, successful trades. So let's say I've crossed 300 positive trades, then I'll increase my position R with cash, not touching the mechanics of the system,
Right.
but increasing my position after a certain number of trades, not necessarily at the end of the week or month or,
right,
or
yeah.
whatever.
As I'm taking what I am doing is I'm taking like a rolling 30 trade expectancy, wins and losses. So that's the R capture. So I can plot that on a scale, and that's the average is my expectancy. And then based on the variation in the scores, I'm going to have Bollinger Bands around that. And when I see that I have something like a very stable, my total R is going up, and my production chart looks like, hey, I am my average R for every 30 trades is in a very stable place. That's a system that's under control, and it has positive results. I should think about increasing my dollars at risk per trade by 20% and see if it still holds. If it 10 more trades and it's still no problem, okay, increase another 20%. And then what you do is you have some number between 0% risk per trade and 1% of portfolio maximum risk per trade. And then you just figure out where on that curve you are. Mathematically, that's probably a better way to overcome your own self-limiting beliefs. But when I became successful, it's because I started with, let me risk $10 a trade and B, positive expectancy, not counting commissions. Because the load of commissions on a $10 risk is too great, too hard to overcome that hurdle. But when I could make money and trade professionally and calmly with 10, then I could go to 20. And then 30. And then 50. Up too much. Go back and try 40. Okay, now 50. Now 75. Now 100. I don't even care what percentage of portfolio it is. Because what I'm doing is building a bottoms-up psychological chip stack about what I can manage. Because I know that in the time, will, pattern, and money, it's my mental state, my will, that is the first thing that crumbles. And what makes it crumble is when I visualize how I actually have that much money riding on the trade. I can't even see it as some fractional percentage of total portfolio. My brain's not wired that way. For me, it was necessary to just start increasing bet size per hand or bet size per trade. That made the difference. And then as long as I don't exceed 1% risk per trade, I'm okay. Does this mean that I am underutilizing capital? Probably. Could somebody criticize me on that? I don't care. Go do your own thing. Why are you wasting time criticizing me? Because I'm not listening to you. I'm 65 and I'm not going to reinvent myself. I'm just going to continuously try to improve. You know, if you looked at, a McDonald's franchise, the margin on an individual hamburger is pretty small. So we'll just sell 6 billion of them, reliably. There is sort of there's a sunk cost of establishing the infrastructure of the trade, and then that thing starts giving you cash flow in the form of positive returns on trades. And if the money that comes out of this is going back into some bag of holding, and I'm comfortable trading $400 of risk, and I like the numbers that I'm generating are worth my time, I don't care what percent. The efficiency of capital is why modern capitalism fails, is because they are over-engineering the system to get the maximum squeeze at every possible moment, and as soon as you get any kind of variation in there, it all comes crumbling down. So I'm not playing that game at all. I'm just trading where I'm comfortable, where I can execute dozens of trades a day automatically with positive expectancy, and just throwing cash into this and then putting that cash into other things that have their own earning rates, like ammunition and silver bullets, case of werewolves, stuff like that. Right. All right, so that's everything I got for tonight. I need to get get on and get the reports finished up. So that should give you guys some food for thought.
Thank you, Ken.
And then Lou, if you, as you generate questions, just send them to me by email, and I'll collect them and talk about them for sure on Sunday mornings and Thursday evenings. They may end up being things that I cover in a podcast too, just because it's easy. But I'll always get them answered on Sundays and Thursdays. And then I do owe you that spreadsheet, Brian. I'll get you that.
Thank you.
Thank you.
All right, fellas. I'll see some of you here shortly.
Okay. Thanks very much.
Mm-hmm.